and you are all set. Thank you so much.
Okay, Chris, thank you. Welcome, everybody. Call the meeting to order at 7:06. And thank you all for attending, including our guests. So at this point, we'll go to, hopefully everybody got the packet that got sent out and you have the agenda in front of you. So at this point, we'll acknowledge our public participation, and we don't have anybody other than invited people at the meeting, so no public participation. Moving on to the next item, we have to review and approve the minutes from our last meeting of August 20th of 2020. And the draft of those minutes was sent out to the board. So was there any comments, or I'll entertain a motion to approve the minutes?
Motion to approve.
Second.
Any other comments, questions, changes, corrections?
None.
None. Okay. If none, those in favor signify, say aye, raise your hand.
Aye.
Aye. Okay. Unanimous. So thank you on the approval of the minutes. The next item we have on the agenda is to approve our meeting schedule for 2021. And this again was sent out to everybody, but just to read it off, our proposed dates for meetings are Thursday, February 18th, Thursday, May 20th, Thursday, August 19th, and Thursday, November 18th. So pretty much staying on the same schedule we've been on, all meetings to start at 7 p.m. So
Motion to approve as presented.
okay.
Second.
Second. Any discussion or changes to any of these dates?
No.
If none, all in favor, please raise your hand, signify, say aye.
Aye.
Passed unanimously. Thank you. So we got our meeting schedule approved for next year. Now we'll move on. We have, as we do every November, we have Pam and Andrew here from Mutual America. And at this point, I'll turn the meeting over, I guess, Pam, to you to start.
Hi, everybody. Good evening. Once again, I'm Pam Gentee. I'm from Mutual of America Financial Group. We provide the 401(a) plan to the town of Orange, and Andrew Kramer and I come every year to review all of the investment options for the plan. Andrew, for those of you who do not know, is the chairman of an independent subsidiary of Mutual of America called 320 Park Analytics. So without further ado, Andrew, would you like to start the investment options review?
Sure. And Mitch, if you don't mind, I spoke to Pam before. I can share my screen and control my slides. Is that okay?
That's fine if I can
Yeah.
figure out how to do that.
Oh, no, I think I can do it from my end.
Go ahead. Can you share screen?
Yeah, I've done this way too many times already.
Okay. Very good.
Perfect.
And so thank you very much. And actually, the beauty of doing is I'm also going to pop into another presentation just to show you some other numbers. So I think one of the benefits of doing it online is I can go from document to document, which is a little bit easier. So I don't want to steal Gina's thunder because I think she'll, from Wells Fargo, because I think she'll do some of what I'm talking about, but I think it's helpful just to talk a little bit about the market, which, sort of helps explain some of the performance of the funds. So what we have here is year-to-date returns as of September 30th, and we're breaking the US market into, on the top, value, core, and growth, and on the left side, large cap, mid cap, small cap. And what you notice if you just start in the middle, this is as of through September, you see the S&P was up 5.6%, but notice mid cap and small cap were down about 8% respectively. So what it shows you is over this year, investors have really focused on large cap stocks. In fact, they've really done is focus on large growth. So if you go to the right side and you look at the top right, which is the large cap growth, you'll see the S&P is up 20.6%, where mid and small growth is around 3 to 4, 1 to 3%. And investors have really focused on large cap growth. So think of those companies as Google, Amazon, Facebook. And then if you go all the way to the left, notice that value has been out of favor, whether it's been large cap, mid cap, small cap. So value stocks are airlines, restaurants, banks, energy. And it sort of makes sense. If you think about it, all I've been doing is using Apple, buying things on Amazon. I don't use Facebook, but a lot of people use Facebook. But I haven't been doing any traveling or going really to restaurants. So that's the way the market's been through this year so much. It's starting to rotate a little bit with the new vaccine that's coming out, but this is through September. Now, as I mentioned, it's been a big dispersion in the market. So when you look at it's been information technology. Information technology is up 28.7% year to date, and consumer discretionary is up 23%. Now, you might ask, why is consumer discretionary up? Because we're not spending money. But Amazon is considered a consumer discretionary stock. Now, on the bottom, you'll see that energy is out of favor. It's down 48%. We're not driving, we're not using a lot of oil, there's less demand around the world. And financials are also down because interest rates are down. So while sometimes you read in the paper the S&P is making new records, it's a very narrow market. And when you look at the market, about 25% of the S&P is made up of 5 stocks. These are the 5 stocks. You could see through September, Amazon was up 70%, Apple 58%. So when you think about which managers have done well on our platform, really, really well, it's been the managers that are large cap growth managers. Fidelity Contra Fund, T. Rowe Price, DWS. Any questions so far?
Nope.
I'll leave the rest of the market over to Gina. Oh, I'm sorry, just one last thing, and this is really more for retirement. And I just wanted to show you, we've shown this chart a lot recently, is because we had a lot of questions from participants about even before the election, should I get out? Even back in March, should I get out of the market? Should I wait? Should I just wait and see what happens and get better? And the answer is really no. So what we're showing here is returns from 2007 to 2019. So notice the blue line is an investor who took $100,000 in 2007, did nothing. At the end of 2019, they're up $287,000. Think of a participant who, that's the gray line, same thing, put in $100,000 in 2007, got scared during the market in 2008, 2009, got out for a year, went back in, still a great return, great accumulation of $164,000, but much less than $287,000. And lastly, you had the participant who actually panicked, went into cash in 2008, 2009, never got back in because they didn't know when to get back in because the market kept going up. They only have $48,000. So the moral of the story really is you can't time the market. You don't know when to get out. You don't know when to get back in. The safest thing to do is kind of stay the course. And really, when our participant reps go out and talk to participants, that's what we're talking about. And lastly, because it's a retirement plan, what you're doing is you're dollar cost averaging every 2 weeks. So every 2 weeks, you're taking a percentage of your paycheck, putting it into your portfolio. So even when prices go down, essentially you're buying stocks a little bit cheaper. Any questions so far?
Nope.
Okay. I'm going to skip because I think we've done this every single time. This is the lineup. Essentially, the lineup has not changed at all. So let me skip to, again, I'd just like to go over the monitoring process. And again, we have a committee, meets with the managers twice a year in person. We've done that for years and years in New York. This year, obviously, we can't meet in person. We've done WebEx. So we met with all the managers back in May and June via WebEx. And in the next 2 to 3 weeks, we're going to meet with all the managers again on WebEx. So we're meeting with Fidelity, T. Rowe Price, IMCO, and and WebEx seems to be working out fairly well. The one thing I do want to point out is I don't think you have a lot of money, but just an example of where we're very patient is American Century Capital Growth. Back a couple of years ago, it was probably a 4-star fund, did very well. And then the portfolio manager retired and they brought in 2 new people. Those 2 portfolio managers didn't do as well. It went down and became a 2-star fund and performance wasn't as well. And that's where we started having conversations with American Century, because we meet with them twice a year to say, look, the portfolio is not performing as expected. You need to sort of make a change because these 2 co-portfolio managers aren't working out. I'm not sure Mutual America was the only one saying that to them, but then they brought in a new portfolio manager who turned around a Putnam Large Cap Growth Funds, which did much better. He's from Kansas City. And since he came over, performance has improved and it's now a 4-star fund. So I think what I want to get across is that by meeting with the managers, meeting with the portfolio managers, we have very good access into these funds, into these firms, and we can actually have them make changes when necessary. Any questions? So I just want to show you net performance. I think I show you this every time. What we really like to do is focus on the long term, on the 10-year time frame. So notice Morningstar ranks funds again 1 through 100. So the blue is the top quartile, which is 1 through 25. That's the best top quartile, and the green is 1 through 50, which is the above median. So when you look at a 10-year time frame, you notice that 52% of our funds are in their top quartiles, respectively, and 76 are above the median, again, respectively, over 10 years. Now, what you do notice, though, is over the last 3 years, that 52% has gone down to 27%. And that's really due to some of the target date funds, where over the short term, they've had a little bit more mid cap and small cap, and that's hurt them. But I'll talk about the target date funds in a slide or two. The other way to look at performance is, again, to look at the Morningstar ratings, and this is as of September. Notice that 62% of our funds are 5 and 4 stars versus an average of 32%. And so that's much better than the average. When you include 5, 4, and 3, we're at 91% versus an average of 67%. So again, much better. When you look at funds that are 2 stars or less, we have 9% of our funds that are 2 stars. So the story is we're happy that that number is much less than the 32%. But again, those are the funds that we're looking at very closely to say, is there a problem with the manager? Or give you an example. A couple of years, probably 7 years ago, we fired 2 funds from DWS, not due to style, due to organizational instability at Deutsche Bank, and the portfolio manager was taking too much risk. And the committee was really uncomfortable with that risk. That's much different than today, where you might have a fund, even some of our own target dates, where they're more balanced, they're not very growth oriented. So they're getting harmed a little bit by the market that's very growth oriented. But again, the market's beginning to change. So any questions on the Morningstar ratings? Stop me if I'm going a little too quickly, because I know a lot of you have seen this slide sort of like year after year. So I'd like to go over the net expense ratio. This is the investment fees. And I probably say this every year, and I do repeat myself because I have kids, but these are the same investment fees that every single client has, and it's the same investment fees that everybody has at Mutual America. So we think our interests are aligned with your interests so that you never need to ask, does a larger client have better fees than us? Does Mutual America employees have better fees than us on the investment fees? The answer is no. And where firms have got in trouble is even firms where they have a fund with a lower share class than what they're providing their clients. That's not the case. Everybody has the same exact investment fees. So when you look at the chart, notice, Morningstar ranks funds 1 through 100 again. 1 is the low. If you're in the first percentile, that means you have the lowest fee. 100's the highest. You notice that 35 funds are in the top 20 percentile for lowest fees. Just about every fund is below the median. And you see that one in the 81 through 90. That's the PIMCO Real Return Fund. PIMCO used to have extremely low investment management fees. But what happened about 2 years ago is, so PIMCO buys futures contracts. And futures contracts have an interest expense. And that's really a transaction cost. But for some reason, FINRA, which is a ruling body, said that no, it's not a transaction cost. You need to include it in the investment management fee. And since FINRA is a ruling body, you need to apply to what FINRA says. But if you think about it from a participant standpoint, their overall fee hasn't changed. It's really gone from one bucket to another bucket. Any questions so far? So this is the allocation to the retirement funds. And what we try to do is they're very balanced between large cap, mid cap, small cap, international fixed income, but they're also diversified between value, core, and growth. Because what we're saying is we understand that participants, when they go into retirement date funds, they have a very long-term perspective, and they're saving for retirement being a long-term perspective. So we're trying to build these funds to go through multiple economic cycles. So when you look at it, just as an example, if you look at the 2045 funds, it has 35% in, an equity index fund, which is really the S&P 500, 21% in mid-cap equity, 6% is in small cap. I'm sorry about 12% in small cap. So very balanced. And you can see, obviously, as you get to 2065, it's about 94% equity and 6% total fixed income. So any questions on the way the target dates are structured? Okay. You're making this way too easy on me. Maybe it's because of WebEx. So then what I just wanted to go over is a lot of numbers. I just wanted to, again, go over the target date funds because, I talked about 2-star funds. Now you notice the 2050 fund is a 2-star fund. The 2055 fund is now a 2-star fund. It's not a 1-star fund. But I think what's important when we talk about the target date fund is, again, we're looking at long-term performance. And when you look at the overall ranking, especially the 10-year rankings, you see the funds are really 4- and 5-star funds. What's happened over the last 3 years, as I alluded to in the very beginning, is it's been a very narrow market, really focused on large cap growth. And if your portfolio is not tilted to large cap growth, you don't do well as other providers. And we believe it's better to be balanced than tilted in one direction. and that's shown by the 10-year numbers. But we do recognize that over the last year or two, it's really hurt us to be in mid-cap equity and small-cap equity and not tilt to growth. But as we've seen over the last week or two, when obviously when a solution comes to COVID, the market's beginning to rotate away from technology, which is getting very expensive, to being more value oriented. So the last thing we want to do is make a short-term movement and then have trends reverse against us. Any questions so far? And then the last thing I wanted to show is just the absolute returns. So let me start with the 2055 fund. Or actually, let's look at the 2050 fund. You see that's the second fund down from the top. So one thing to realize though, even if you're a 2-star fund rated by Morningstar, it doesn't mean participants are getting poor performance. So when you look at the 2050 fund, notice in 2018, you were up 25%, 2017, 18%, even going back to 2013, you were up 28%. So you really did get strong performance in very up markets. Now, 2018 was a down market and you were down about 8%. So I think what I want to get across is, yes, Morningstar is one way to look at the funds and we look at their rankings, but obviously we want to look at where we are in the market and we also want to look at the absolute returns versus their benchmarks. Any questions on the target dates? And the last fund I actually wanted to go over, because you have a large balance in Fidelity Contra funds. So the Contra fund is the third fund down from the bottom. Now, Contra fund is a large cap growth fund. So they have, large allocations in Amazon, Facebook, Google, and it's done very well. So when you look at, I'm sorry, I wanted to show you. So I do get to flip a lot. When you look at the 1-year return ending 9/30, notice the fund is up 34%. Its index is the S&P 500, and that's up 15%. So that's double the S&P 500. Because again, the return you're getting from the S&P 500 is really made up of 5 stocks. Even when you look at 3 years, the fund is up 16.74% versus 12.28%. So this fund has done very, very well, whether it's a 1, 3, 5, or 10-year time frame. So I wanted to make that note because you do have a large percentage of assets within Contra funds. Does anybody have any questions?
Nope.
It's either that good a presentation, you've seen it too many times, or it's too late at night already. I can't tell which one it is, to be honest.
It's just it's straightforward, Andrew. Thank you very much.
So I'm going to hand it over to Pam. Maybe I'll have some questions for Pam.
Okay. So what we're going to talk about first is we review each year the benchmark report. Mitch, would you be able to share the benchmark report with everyone? And actually, we're just going to talk about the first couple of pages. I think there's only 3, but.
Do I have that?
Yeah, the first attachment.
I have it, Mitch, if you can't.
And I have it also if you need to.
If Eric, I could probably figure it out, but I don't have it in front of me. So
Hold
You want me
on.
to bring it up?
There. Does everybody?
no. But there you go.
Perfect.
Good
All
job.
right.
Thank you.
Eric's quicker than I am.
Pam, that's the right screen, right, Pam?
Yep, that's the right screen. And then we're going to flip to the next one afterwards. But basically, I just want to look at the top. Right now, there's currently total 190 participants. Active, there's 163. The total plan assets are a little bit higher. This was run, I think, on the 27th of October. As of last night, you guys have 20 in the 401A plan, you have 22.9 million. But, you know, as I said before, each year we provide you with this customized benchmark report that basically calculates the dollar weighted average of all plan expenses to get a ratio of plan expenses to total plan assets. And this is compared to the other plans out there that are your size. So if we just slide down a little bit, this is a helpful tool because it's helpful since individual investment options have different expense ratios. So for instance, your plan right now has a total dollar weighted expense of 0.81%. Now, what this is made up of is right now the total underlying fund expenses. There is not any charge for record keeping. And basically, it's just compared to the average plan of your size. Right now, the average plan would be 1.01%. Now, this information that we get is totally independent. This report is provided by the 401k averages book. The data is based on your total plan assets, average account balance, number of participants, and asset allocation. Now, there are, as Andrew had pointed out, there are a lot of assets in stocks. So the expense, you know, may be slightly higher. This is not data that Mutual of America has gathered or provided, you know, to this company. Now, the 0.81 versus 1.01, that's percentage. If you just flip on to the next page, it's converted into actual dollar figure. So your plan is costing $182,142. The average plan, based again on your size, is $227,887, $227,000. Now, I know we talk about this every year, but I do want to point out that you are getting closer to a significant pricing structure reduction. Currently, the plan's separate account annual expense pricing structure is at 0.45%. Again, as of last night, the assets were up a little higher. Your total plan assets, and this is including the 457B plan, right now is about $23,436,000. When the plan reaches 25 million, the separate account pricing structure will drop from 0.45% to 0.35%. You still have a little bit of a ways to go. There's about a 1.5 difference, but you're definitely getting closer, you know, to the what we call tier 2 pricing, the 0.35%. And I wanted to point that out. Any questions? Okay.
All right. More good markets to get the returns up get us over 25 million.
Right now, year to date, your premium has been 1.3 million. Just to give you an idea of how much you put in every year. So, you know, it's definitely realistic. Probably won't happen for, you know, probably again, you know, Eric, as you're saying that, you know, with the market that keeps going up, maybe next summer we'll hit, you know, a new pricing reduction. But what I want to talk about now is a little bit about our new platform. And Andrew, please feel free to add anything because this is still new for us. I'm going into training about this, you know, about this whole platform in the next 2 weeks. So I'll have a lot more information. But it's coming out the first quarter of 2021. And basically, we are going to be changing to a net asset value platform, which means we will be offering mutual funds instead of the group annuity product. Basically some changes are going to include a major upgrade in our technology. We're going to have a new plan administrator portal. We're going to have a new participant internet portal, which will include manual and automatic quarterly portfolio rebalancing. The new platform is going to offer virtual guidance and enrollment assistance to participants. We will be adding a mobile app for Apple and Android phones. We are now going to offer 66 mutual funds to choose from. Now, clients, you can narrow your options down to a core selection if you want. You can add or subtract funds at your discretion. There will also be an ability to add a fee to pay for an outside investment advisor or investment manager. The one thing I do want to add is in the past, we've always talked about our indemnification and hold harmless agreement. This is an insurance policy, or I should say an added insurance policy on your platform, on your investments. The new platform will always include our fiduciary support by providing indemnification protection against liability, losses, related expenses from fiduciary claims, against or in respect to our investment choices. We stand 100% behind our investment selection and monitoring process, and that all is still going to stay the same. So Andrew, do you have anything that you want to add to this?
I guess first of all, does anybody have any questions?
Yeah.
None.
It's a good thing. I mean, this is great.
And I think the reason we brought it out is just for flexibility. Right now, you get all 47 funds, which everybody has in Mutual America. But some clients are like, well, we don't want 47 funds. We may only want 30 funds. Mm-hmm. So, it allows a little bit more flexibility to a sponsor that may want it. And that's kind of where we're rolling it out. It's going to have ticker symbols, which I think everybody likes. But a lot of the same funds, the platforms are very similar. So the funds that are on the current platforms are going to be most of the funds on the new platform with some new funds. So for example, take T. Rowe Price Blue Chip Growth. That's on our current platform. On the new platform, it's the same fund, but it's an R6 share class. So we're looking to have the lowest share class possible. So we really want consistency between the two platforms, so it's not totally new to participants.
And Pam, when is that supposed to roll out?
It's starting, I would say February 1st, but
I'd buy more April 1st.
April 1st, okay.
I'm more conservative.
And it's going to be slow. It's not like a light switch is going to go on and poof, you have a new platform. Little by little, we're going to be, changing everyone over.
And you had said you're going to be expanding from about 47 funds currently to 66. Mm-hmm. So is there anything that we as the board will need to do to either adopt those additional funds, or if we want to limit the overall, because 66 funds could become overwhelming for some participants? Is there any time frame that we have to act in advance of that, or can we do that at any time?
There's no time frame, and I think before you move, we have a discussion, because 66 funds is way too many funds, right, to be honest. I mean, one route is you could take the funds that you have today and just have the same funds that you have tomorrow, but they're a mutual fund instead of like a variable annuity product. So there's not a lot of change and you would still have 47 funds. Or you might say, well, we don't want 47 funds, we only want 30 funds. And then, you could talk about how you actually would make that change and how you would the board do it themselves? Would you use a different fiduciary? So there's a lot of conversation going on about this, how it actually works.
Okay.
So again, like Pam said, it's not flip a switch. I mean, I think we want to be very careful, very prudent, and make sure that some clients may not want to change at all. Some clients are happy, things are going well. Because again, it's all about asset allocation, it's all about participation, contribution rates. So that's really more important than sometimes the funds themselves, to be honest.
Sure. No, I appreciate that. More, I was asking just timing that, for this board, which only meets quarterly, if you're talking about, something coming on, and I understand not a switch on April 1st, but sometime in the, second quarter of 2021, if there's anything that we need to do or be prepared for, just if you could funnel that to us so that we can make sure it gets on our agenda.
Okay.
I think Andrew, kind of hit it on the head. This is just going to offer more flexibility. You can keep everything the way it is.
But I think, Eric, to your point is, we'll come out.
Yeah.
Maybe, Pam starts putting something on your agenda, maybe in March, to really sort of dig a little bit deeper into what it is, more about the timing, things that you may need to do, things you may not want to do. What are your thoughts on moving? So I think more as we get closer, it's a conversation, because you may say, I don't want to move April 1st. I can move at the end of 2021.
Yeah. Well, but I also don't want to end up that there's a bunch of additional fund options. Participants start selecting them, and then we all of a sudden pull some back, and whereas we might do that we as a board might decide in advance to just keep 45 funds or 40 funds or something like that, and so that you're not taking anything away from people. So it's
exactly
just a planning standpoint.
Yeah, exactly. So the right way to do it is decide what you want to do, and if you want to limit the number of funds, you first limit the number of funds, and that's your menu. And from there, you then move over. So you're right. So you don't get a participant going to a fund, and then a week later you take back that fund.
Right.
That's the wrong way to do it.
I completely agree, and that's why I wanted to know the timing, so that if all of a sudden and this becomes in between our meetings, that if we don't act on something that 25 additional funds are just all of a sudden going to be on the platform, we don't have time in advance to react.
All right. That's not the case. Those funds only get flipped on if you decide to move over to the new platform.
Okay.
Okay. And I will keep you posted.
Okay.
I'll keep John posted on everything that's happening. And again, as Andrew said, this is first quarter starting, so it's not just a light switch.
Yep.
Last thing I wanted to just touch briefly on is the employee education part. Usually we come out there a couple times a year. We're on site. We meet with employees. We usually have a full day. This year, things are different. Lana Robinson has been sending out sign-up sheets, and this is something that we can talk to John and Audrey about. She would be happy to spend a whole day meeting via WebEx with individuals whenever, whenever it's convenient for you. So that's something I just want to mention. We are there for education, and we are available at any time to meet with employees.
John, are participants all aware of that they can request a meeting at any time?
Well,
Yes, they call our office quite frequently, and we refer them up to Pam and her crew up there. As Pam said, we stopped it naturally because of what's going on in the world for this year, but it looks like things aren't going to change for the first 6 months of the coming year. So we will go to the video and offer that for all day, or how many people we need to provide for.
I mean, Lana talks to people all the time from the town of Orange. So they are calling her. They know to call her. She's actually quite busy. But anytime you want her to send over a sign-up sheet for a WebEx days, she is available.
Okay. I appreciate that. It's more not from you, Pam. It's more, historically, we've had some challenges in terms of communication out to all employees and either police or town employees. Just want to make sure that communication is continuing to go out.
John, do you want me to send you Lana's phone number? So maybe we could just do another.
Yeah, maybe we could
Yeah.
put something on the schedule for March. So I know she needs a little lead time there. So I think after the first of the year would probably be good.
Okay.
February or March.
But for now, should we do something where at least we can send out?
Oh,
I'm sure they.
why don't you do like a little pamphlet or flyer that I could email to everybody that she's available with her number to call and all, and a little marketing thing. That's probably a good idea.
Okay, good.
And we'll get that right out as soon as you get it to us.
Okay.
That sounds great. And that's it for now, unless anybody has any questions.
Mitch or Barbara, do you have any other questions for Pam or Andrew?
No, everything was very clear. Thank you.
So, okay, Pam, Andrew, thank you very much. We really appreciate you stopping by, as it were.
Thank you.
Thank you so much. It was great seeing everyone. Hope to see you in person next year.
We all hope so. Absolutely.
Thank you.
Okay.
Thank you very much.
Thank you very much.
Bye.
So next on our agenda, we have Gina from Wells Fargo, and I'm sure Gina has some information on transitions and things going on. So Gina, at this point, I'll turn it over to you.
Okay, thank you. So the transition for your account is going to happen probably third quarter next year. So we have some time. As we start to, they're moving accounts over in waves right now. And they're focused right now on the record keeping side. And all of the trust and custody accounts are going to go over at the same time. It's going to be one migration. So it's scheduled for Labor Day weekend next year. But prior to that, I will be communicating what the changes are. It's going to be the same platform you're on today. The operations center is not changing. The same people who work on your account today will be working on your account once it migrates over to the principal side. The only one thing that I have mentioned is today, if you're accessing your statements online, you're going to be going through the principal's portal, not the Wells Fargo anymore. And also if you have any of those VPNs to get into the system for benefit payments, you won't be needing a VPN on the principal side. They have a secure website where it's going to be much easier to get in and out of, with the password, and it's got an authentication that's different there. So today I don't have a whole lot to share. I'm here to answer any questions you might have about what's happening when we go over. And one of the reasons why it's taking so long is, again, they wanted to do this very slowly, very methodically. And also they want to bring out some bells and whistles on the trust and custody side, not just say, okay, here you are today, here you are tomorrow. So they are building out a lot of new features that I've been hearing about that are kind of exciting, and we'll be communicating those probably early next year. I'm excited, everybody, about moving over there. I got to be honest. I like the people that I've been talking to. I like what I'm hearing, and it's just going to be really good for everybody.
Good. And John, everything has been going well with you and Audrey with communication to the Wells Fargo group and back and forth?
Yeah, Audrey handles most of the daily stuff or monthly stuff on that, and I haven't heard anything bad. We just had that one report that we're losing that we've talked about with Gina.
Yeah. Has that impacted you much on that, John?
It's impacted Arthur.
Arthur, I don't want to upset Arthur. Yeah, you and I had talked about that, and I'm sorry that happened. I mean, we could have provided it. Obviously, it was going to cost money to do that under the other option. I mean, I'm here. I can provide any kind of information. I don't hear too much from Audrey, and usually when I do, you know how easy I am to get a hold of, John.
Yeah, we know that.
So, and I'm not going anywhere. Pretty soon, I guess I'm going to be locked down in my own house if this keeps up.
Hey, just join the rest of us, right?
Well, it's funny. I back in February, I was reading up. I listen to news all the time, so everybody sort of called me an alarmist when I was like, stock up your cabinets because something's coming down the pike. I got laughed at in the office. I got a lot of apologies in March. I'll tell you that. And I had everything I needed except toilet paper. Did not see that coming. So it was the office. I hit their supply, but I was reading about the Spanish flu back then, and it's following the exact same track. It's amazing. And talked to someone who's an epidemiologist, and they were like, "You're right. It is. The only game changer for us is the vaccine in 2020, and that will be the game changer."
Absolutely. So any other questions for Gina?
No, thank you for coming.
Yeah.
Thank you.
Information.
Chris is on. Chris, do you need me to stay on for your piece?
You don't have to, Gina. No, I think we're good. I mean,
Okay.
I would defer to the chair and the members if you'd like to, but you don't have to.
No, I don't think so. But
All right. It's good seeing you, Chris.
You too, Gina.
Okay, everybody, take care.
okay.
Thanks, Gina.
Thank you.
Thank you. Thank you, Gina. So next on our agenda, we now have Chris Katchmar from FIA. And although maybe your name isn't quite FIA anymore, Chris, is it? So I got
No, it's you see there with the tagline up in the upper left-hand corner on the cover sheet. Can everyone see the screen? Okay. DeMeo Schneider and Associates, just as an update, that merger is going frankly ahead of schedule. It's certainly tough to paint anything positive related to the pandemic, but the fact that we're not in planes and in cars and running around and doing meetings like this has given us some more time and capacity to work through the merger. And we're ahead of schedule and integrating the research teams and the service teams and operations and whatnot. So things are going well on that front. I don't know, Eric, if that's enough for folks in terms of an update on the merger or not. But if folks had questions on that front, happy to entertain those.
Yeah, I'll leave it to the group if anybody's got any other questions.
Barbara, Mitch, okay, John, okay, all right, good. So things to tackle this evening. I know we're running up here to 8 o'clock, so we don't want to spend too long. This is the quarter where, if you remember, where we kind of step aside and try to gather some peer information around the state on just high level actuarial trends and kind of what we're seeing statewide. So we actually have a team internally that goes out to the John will know this, the consolidated financial statements, the CAFRs, and kind of digs through those and pulls out some of the high level pension plan related data in those reports. And the things we're going to focus on today are really threefold. They relate to just generally funded status across the state, discount rates and trends, and then finally a little high level information on the performance front, the investment performance front. You see in the upper left-hand corner, we see we've color coded there, and you can still see that in terms of funded status, right, the biggest cohort is somewhere between 70 and 90% funded. I think on a statewide average there, you see down in the observations in the lower half of the exhibit here. I think this is a simple average basis, 75% funded, but there are certainly meaningful swaths of your peers, that are less funded than that, and even a handful that are slightly more funded, but kind of hovering in that low to mid 70 rate is where the biggest clusters are. That goes in hand, and we'll see when we draw some comparisons to the the town of Orange attributes. That goes in hand, of course, with discount rate, right? Because are well aware, and we've lived this. You lower your discount rate, and your funded status goes down too, right? So you folks, if you remember, have I would deem it a materially lower than statewide average discount rate, right? You're down at 6 1/4. If you see over in the upper right-hand corner, this exhibit, while rates over time have trended lower statewide, they still on an average basis are up around 6 3/4, right? Probably a full 50 basis points higher than where the town of Orange is today. So you folks, right, I think have been conservative, have been ambitious in terms of reducing that rate, and appropriately so. It does come in hand with pressuring funded statuses, as we all know. But again, right, in terms of the totality, the health of the plan and the direction and the things that you're doing to address that, I would kind of deem that you're ahead of the game in many ways. It's not too long ago, right, when there were, that's interesting in this chart here, go back to fiscal year of 2014, if you can see it, and you can see that the biggest cohort was between 7 1/4 and 7 3/4. And you can see the progression now down into the high 6 range, that yellow bar. And again, you folks are ahead of the game on that front, as mentioned, down, much more conservatively postured than many of your peers. So I think that's a good thing, right? On the return front, you see here on a fiscal year basis, right? We've had kind of some very good years and some not so good years on a fiscal basis. It's not mentioned here explicitly, but as a comparative for the committee this evening, you'll see here down in the observations, I'm going to just pick out 2 numbers here. The 3 years trailing, this is again through fiscal 19, so through June of 2019. Statewide, the average investment return for plans was 7.9%. The town of Orange's number over that same time frame has been 8.2%. So a little bit of a performance advantage. The 5-year number you see there referenced is 5.2%. The town is a touch lower than that, but not materially so, at 5% annualized 5-year number through June. What I would mention here, which is an important distinction, is we don't control for allocation, right? So we're just aggregating all these investment results and drawing comparisons. I would say, as you folks know, we work with 35, 40 municipalities across the state. You on margin are more conservatively allocated, I think, than many of your peers, right? The system or the plans are somewhat more mature. So with that conservatism, right, the return potentials maybe on the margin a little diminished. So I think to the extent that you're conservatively postured there, but outpacing and then holding serve, if you will, with those broader state returns is probably, kind of a good comparative as well. We kind of bring it all together here. This is, again, just lifted from Milliman's reports. This is the police plan. We don't need to revisit these, right? We know what the funded status is. And again, we mentioned the 6.25%, and that obviously debilitates the funded ratio comparison a little bit, again, because you're lower than peers as discussed. And then the other plan, the employee plan, the town plan, 62%, again, 6.25. I think if you were to control for and on an equal footing basis, right, discount things at 6.75%, your funded ratios, right, would be not dramatically, but I think meaningfully higher and probably much more akin to what you see statewide, certainly in the case of the town plan. So no action items for the committee tonight, just some information to share with you. So you've got a little bit of perspective and context. I know we won't see the Milliman folks again, I guess, right till next summer, but just things to kind of think about along the way here. Again, I think this group has always been very proactive and thoughtful in your conversations with and outcomes with the actuaries, and you are in many ways on the margin more conservative, if you will, than some of your peers. I think ultimately that's to the benefit of the town and the plans as well. Anything I missed on that? Again, I apologize. There's a lot of data there. If you subsequently, to the meeting tonight, look through it and something doesn't resonate or you have more questions, of course, just track us down and we can get you those details.
Chris, one thing, I know we've talked about this in the past. Our plans have been frozen now and closed for really quite a while. Is that typical of other municipalities in the state, or are there still a fair amount that have open active plans?
I would say that on balance, it is probably, if not outright closed, it's Eric, probably frozen, right? Would be probably the most popular cohort in some form or fashion. Although I would tell you we work with a handful of plans that are still open and accruing. New employees come in and they're eligible for the pension plan. So it kind of varies all over the place, but I certainly think the broader trend statewide has been freezing plans at the very least. And you folks just talked about it, right? The advent of the defined contribution programs in many ways is a response to the fact that these legacy pension plans are things that towns really aren't that anxious to, there are not a lot of new pension plans opening up, let's put it that way, right? For all the reasons.
Eric, anecdotally there also, there are still some plans that are open that I'm aware of, mostly in the cities, not all. If there are communities that have bifurcated their plans, it's sometimes the emergency responders, police, and in those cases where there's a paid fire department, will also remain in a pension plan for recruiting purposes, not for financial purposes, but there's also a number of towns and cities that have moved to the state plan. I'm not sure that's a wise move financially at all. But I think Chris is on the mark, though. There's a myriad of different ways, but most are closing or grandfathering, if you will, their employees and moving to this same moving to defined contributions, certainly for new employees. Mm-hmm. The towns or cities, that most seem reluctant to move off the defined benefit to defined contribution are towns and cities that do not have Social Security. There was a way for opting out years ago from Social Security. And if you move to defined contribution plan, you have to add Social Security. Right. So the cost of the move to some towns and cities that have not paid Social Security, the cost of matching a defined contribution plan and adding Social Security to that outweighs their cost of a pension plan. Orange has always had Social Security for all its employees, which some people neglect to find. I mention that because we do hear about sometimes police officers leaving because they find a community that has a defined benefit plan and they want to go to one with a defined benefit plan. But I often caution people, sometimes too late, they're moving to a defined benefit plan without Social Security. Whereas in Orange, you had a defined contribution plan plus Social Security. So grass is not always greener.
Okay.
That's great perspective, Mitch. Thank you. Gina talked about the update, right? I would just offer up kind of at a very high level that, some of the markers that we look at in terms of the transition and the integration seem to be progressing consistent with expectation, and certainly wouldn't expect there to be any disruptions ultimately when the full transition is made. We'll of course keep you posted. I'm not going to spend it, Andrew touched on some of this a little bit. We go into a lot of more detail sometimes, but maybe just highlight a couple things, right? What I would start off with, I think, as everyone well knows, there's basically 2 or 3 factors that have really driven investor sentiment year to date. And they're, I think, obvious to everyone on the call, but worth repeating nonetheless. And it relates to the general state of affairs as relates to the pandemic. Certainly Monday was a good day with the vaccine announcement, and today was not quite as good a day. And we've seen where all those metrics are going, which maybe is not particularly encouraging. Hopefully we're on the heels of the election cycle, and that this thing will settle down in the next week or so and offer up a little bit of stability on that front. And then that sets the table right for wave 2 of stimulus. So were we to get stimulus at some point here in the not too distant future, and a vaccine in the middle of next year, for example, you can make the case, I suppose, that the undercurrent, the economically and the fundamentals are actually, all things considered, not that horrific when you kind of, and you can't completely, of course, but when you kind of stand away from the health crisis a little bit. So investors have continued to kind of view those things in largely a positive light, as you see here. These are global equity returns for the quarter. Global equities on average were up about 8% in Q3, particularly noticed in July and August, and then you see the tail off in September. Andrew mentioned the tech sell-off in September as well, and some valuation and regulation concerns. But when you kind of blow out the view a little bit, you do see for the quarter, by and large, pretty strong, equity returns, right? I think there is legitimacy to the idea that within the S&P, for example, that a lot of that return has come out of just a handful of stocks, but they are constituents in the index, and it does contribute to the total return that investors have achieved and enjoyed there. And again, that sentiment, right, and that appetite for risk is carried down pretty consistently across the equity markets globally. And then interest rates, by and large, have been well behaved, but are still very modest, as you know. So the returns there, while positive, are much less so. So you see the broad markets up about a little more than 1.5% in Q3. Kind of a mixed bag, I suppose, in terms of the alternatives front. You look down in the lower left-hand corner, but REITs were positive. Commodities were positive, and we'll see some of that flesh out when we look at the portfolio in just a second. I mentioned those kind of undercurrents that are stabilizing and somewhat encouraging, and these purchasing manager indices, the composites, are a metric that investors have kind of increasingly looked to as being a good kind of broadcast for the potential trajectory of the economy going forward. And you see there, right, during the throes of the crisis initially, the big downdraft in those numbers. And then those numbers start creeping up again and stabilizing. Without getting into all the boring details for the committee, this is like one of these diffusion indexes. So if you're above a 50 reading it indicates economic expansion potentially, and below that is contraction. So you do see those indices kind of hovering a little bit north of 50 on a global scale. So that idea that there is some pent up demand once things stabilize is got a little bit in the way of support in this metric anyways. It's going to be a down year in the economy for 2020, right? We all know that we're other things equal, that we'll have a contraction in economic activity start to finish, although you do see forecasts turning more positive in 2021 and starting to ramp up again, maybe led by China, as you all know, which actually has recovered economically anyways, more rapidly than the rest of the world, given the timing of when the crisis hit there and kind of the government response. So, softer economic data, but nonetheless, you do see there some green shoots perhaps once things stabilize a little bit. Won't spend a ton of time here. Valuations in the U.S., equity valuations as measured by multiples, right? The U.S. markets have done much better than international markets for an extended period of time, although not so much very recently. And you see the valuations reflect that, right? Valuations are somewhat higher than they are in the international markets. We talked about, you've heard about the tech story tonight as well, right? Tech has been the predominant source of return from a sector standpoint, at least through the end of the third quarter. Country returns kind of a mixed bag. I think what's interesting here, right, is you see the third quarter and year to date and some of the kind of the disparity in those figures, right? So the US, China, Japan, Germany, India, all having particularly strong quarters, but other kind of cohorts around the world, not quite as much, and some pretty dramatic down numbers. Brazil, for example, on a year-to-date basis. So there's been some dispersion in country returns as well. On the fixed income front, just quickly here, this is, I think, the biggest thing for us to consider as we kind of look at the portfolio and think of its return potential going forward. Low base rates, right? 10-year yields that they're a little higher today as we sit here, but at the end of the quarter at about 66 basis points. Those yields have typically been pretty good precursors for what fixed income markets do more broadly. The broad fixed income markets yield about 1.25% today. So we've just got to be mindful of that in terms of return potential for the program. I'll just step aside and mention next quarter when we meet, we're actually going to do a full-blown asset allocation review for your portfolio with our latest capital market inputs, and we'll give you some color and perspective around the return potential for the program over the next several years. So that's probably enough on the fixed front. I think we've kind of talked on the notion that volatility has been elevated, and we've talked a good deal on performance. Growth versus value. We're going to spend a minute or two when we look at the lineup on the value strategy in the program in a minute, but growth is still pretty handily outpaced value, at least through the end of the third quarter. Value is doing a little bit better more recently. The dollar has been very, very strong, as you know, for a long period of time, not so much in the third quarter. When you look at kind of our containment efforts on the virus front in the US and the need for more stimulus perhaps, and the interest rate differentials not as pronounced in favor of the US. So that has been kind of a headwinds, if you will, for the dollar more recently. This page here kind of gets into the notion of we've got all this stimulus. Doesn't all that stimulus and money supply ultimately mean we're going to get a lot of inflation, right? In the past, when you see these little kind of crop ups in money supply, sometimes they link with higher inflation. I think the thing that we would mention, right, is that alongside money supply is this idea of the velocity of money, right? How fast money's moving through the economy. And it's not moving that fast through the economy right now. Actually, if you look at the demographics of the country and investors and the cash stockpiles that people have and the like, I don't know why my screen is doing that. That's not good. We don't think you're going to have outsized inflation anytime soon. Is the basic takeaway. Everyone loves to talk about elections, right? We have had the elevated volatility that we've talked about a couple of times. What's better for the markets? There really isn't a definitive answer. It seems like over time, the best outcome for markets is split political persuasions. So the executive branch is of one party and the legislature is of another party, which, perhaps that's what we end up ultimately here at the end of the day, given what happens in Georgia. And that generally has been the backdrop for the best returns over time. So we'll see how that all plays out. But again, it ultimately comes down to the economic footprint and the fundamentals, where we are with valuations, right? They have the more enduring influence on markets versus elections. No big changes to our stancing. And we've talked about these for some time. We're kind of in the midst of the cycle with some uncertainty. So you see lots of those stances, as you would expect, are kind of neutral right now, seeing where things flesh out. And that brings us to the portfolio. So let me pause there for a minute. Any questions on the broader economy or markets or investing conditions before we spend a few minutes on the star of the show here?
Nope.
Sounds like folks are okay.
Yeah.
Here's the portfolio at the end of September, just a touch shy of $26 million. Allocations, as you see, are largely, not precisely, but largely aligned with target weights. We did work with Eric back at the end of October to raise a little bit more cash, just to keep the liquidity profile in place through the end of the calendar year. So kind of when you think collectively of the cash position and fixed income, they kind of aggregate to a collective number that approximates the fixed income target. So I think we're in pretty good working order from an allocation perspective. And we did source that in October. We did source from the overweight equity areas of the program when we did take those monies. So we'll keep you posted on that front, but I don't think we have any big allocation decisions today. Up and down the lineup, what I would tell you, you'll remember that we continue to, or I should say, we continue to keep American Beacon large cap value on watch. You'll remember back a couple of quarters ago, that's a sub-advised strategy, and one of the long-standing sub-advisors in the program had been terminated. We'll look at performance in a minute, but that is a one strategy that we are spending some more time on, and we'll keep you posted on if we think we need an action, not tonight necessarily, but in the near future. And we did return Templeton a little bit further down the list to maintain. You'll remember that strategy was on watch for a couple of quarters. There was some shuffling of the heads of the investment outfits and whatnot, but the team that administers to your mandate has remained consistent throughout, and their approach remains unaffected by those changes. And the changes at the executive level there at Templeton have taken hold nicely as well. So other than that, the rest of the program, I think, is in pretty good working order and kind of positioned and performing consistent with expectations. Any questions from the group just on general asset allocation, or what's in place on the program, and what's in place for the program in terms of statuses? People okay?
Yep.
All right. And then what the kind of the star of the show, the number we all wait for with bated breath, down in the middle of the page, it was a good quarter for the plan. You can see there the portfolio was up about 5.6% in the third quarter. The benchmark was up a little bit less than 5%. While the numbers year to date are modest, you can see there, these are calendar year to date, of course, at 2.2%, ahead of benchmark, but modest. I'm hard pressed to think back in March, right, when the world was in such a chaotic state and markets were in such flux and disrepair, that as soon as the third quarter, we would be talking about year-to-date positive returns, but amazingly enough, we've got them. So we'll take them. And then you can see the longer dated track record, kind of a nice 1-year outcome, I think, through September, through all the thick and thin and all the noise in the markets. The plan did run off an 8.3% return and was comfortably ahead of the benchmark, as you see there. And that is, as we know, been the case for an extended period of time through the plan's life, right? It's generally had accretive results from the managers along the way on net of fees. So I think we're in pretty good working order on the consolidated performance front. Maybe I'll end just quickly with kind of a quick run through the lineup here again, and we won't spend a ton of time here. I think similar to what Andrew talks about with rankings and whatnot, we give more credence, I think, like they do, to the longer dated numbers. I was just kind of doing some mental accounting here when the folks from the Mutual were speaking. And it is, I think, right, with the benefit of time, you do see a lot of the managers in that top quartile or close, right, longer term, which is obviously what we're going for. Brandywine has not been in the top quartile, but we have seen improving performance more recently, and I think they will get back to it and recover pretty quickly there. American Beacon has been kind of a middle of the road, large value strategy that's, been in the program for an extended period of time. And again, I mentioned the watch status, so we'll keep you posted on that. I don't think we need to take action just yet, but we're mindful of that. Harbor, upper left, right-hand corner. Harbor's done pretty well, as you can see there, top decile or thereabouts. The index, right? Who would have thunk it? But the index, the small and mid-cap index, has been just a superstar relative to active peers, right? For an extended period of time now. You're getting top decile performance from an index strategy, right? And paying a handful of basis points to do that. So that has been a winning hand. And when we're thinking, right, about where you spend that active budget in terms of fees and kind of mixing and matching, we'll take that type of a track record all day. And then the international managers have kind of been consistent stars of the show there, as you can see, longer term, both Dodge and Cox and Euro Pacific Growth, rank at the very top of their respective peer groups. And Templeton, now off watch, as mentioned, has been essentially a top quartile performer as well. Cohen, you'll replace Morgan Stanley a couple quarters back, and they've gotten off to a good start for your program as well, as you can see there, almost doubling the index return in the short time you've had them, and kind of been up near the top of the performance rolls. So just highlighting a couple of managers on those pages. The balance of the report just has all the gory detail at the manager level. And my inclination is we can set that aside unless there's questions that people want to get into. So let me pause there and see what folks think on the performance front, if there's anything of interest or note.
Mitch, Barbara?
Yeah, I think it's straightforward and it's positive news for us. So thank you, Chris.
Yep, agreed, Mitch. So that's Mr. Chairman, all I had for the group tonight.
Yeah, Chris, just two quick things. One is, and the page that you're on, I guess it's important to kind of bring back to our conversation earlier that if we look at, really over the longer term, 7-10 years, what the plan has earned, relative to, what our discount rate is, that, we really are, kind of tying into that. So, and the 7-year is 6.3 and we're at a discount rate of 6.25. So I guess, we are on the right track in terms of what our discount rate is based upon, what we can expect to earn over a long period of time.
Yeah, and I think we'll have more color on that, Eric, right? In our next meeting, we'll run the allocation study for you and we'll show you on a go forward basis what the return potential looks like when we have our new inputs capital market inputs. So that'll be a good exercise alongside that. But yeah, I would agree with your sentiment entirely, right? It is interesting that you, 7 year, 10 years since inception, you kind of frame those numbers, the 7.1 and the 5.3 around the 6.3. And like you said, right, you're kind of right in the low sixes on a longer term basis or thereabouts. So
Right.
it is pretty telling.
Okay. And the other question I had for you, Chris, is, and this is more just in terms of planning and from what, Pam and Andrew had raised, in terms of their, platform and expansion of fund offerings, should this come up at the committee and should we need this, is this something that, as almost a backstop that from your standpoint, FIA, if we need to kind of, look at that fund investment options and, streamline that at all or make any adjustments that that's something that FIA could assist this board with?
Well, we do, as you know, Eric, we do a lot of work in the defined contribution arena in the municipal space as well, right? I've always been sensitive, and I don't want to step on toes, right, with the relationship that you have with mutual. We do a lot of work where we would go out and kind of test them as a record keeper versus the marketplace, where it would be a bigger picture thing. The more direct answer to your question, I think we could certainly render some assistance on the fund front. I would tell you that 47 funds is entirely too much in our estimation, right? Participants don't know how to use those.
Yeah.
I mean, you look, if you have in our practice, I think we have typically maybe 16, 17, 18 funds in a lineup. I'm including target date funds as a single offering, right? And you work across the risk return spectrum. You might have a money market option, right, or a stable value option, depending on the record keeper. 1 or 2 fixed income options, maybe 3 or 4 domestic equity and international equity options with an index ability across the lineup, and then a good target date suite. We've always struggled with the idea of 47 funds or 50 funds, or isn't it great that participants can select from 60 funds, but they don't do it, right? They just don't do it. They're not inclined to spend the time trying to understand 60 funds. They get overwhelmed by the data. They sign up and they put it in the money market account, and then they forget about it. And then, 20 years later, they've got about the same money they started with. So,
Okay.
I got my soapbox there a little bit unintentionally, but yes, we could help you if you'd like to.
I think it's something that going into next year that we as a board will have to look at a little more deeply with Mutual of America and on a broader sense.
Yeah, Derek, I tend to agree with Chris, and having dealt with people in Guilford who are choosing defined contribution plan funds. Most of them today are just choosing the milestone fund. Why? Because they're overwhelmed with everything else. They can't sit there and figure out an equity versus, the bonds and versus this. I think the growth versus value, unless they have a financial planner. Right. They do, the financial planner will help out. And so I'm not saying don't offer any funds, but I think the more funds that are offered, the more overwhelming it gets. And so I tend to agree that we've got to keep a limit on that for our participants' benefit.
Yeah, clearly for participants. John, you seem to have a comment.
I totally agree with Chris and Mitch there. When I heard 60 funds or 40 funds, that's way too many. Where I was in the past, we started when we opened up our defined contribution plan. I think we started with 10 funds, and I think when we left, we were up to 18, and we were diversified within the group, 1 or 2 funds, so they were able to pick whether they wanted to be more conservative or more aggressive or whatever. And I think that's what they need to do. I believe, and Barbara, you're the attorney, that if you give them too many funds, you also could have a liability out there that you're giving them too many and not enough information on what to do, and they do get overwhelmed.
It's hard to educate to that much.
Yeah.
Yeah, I think that's right, Barbara. We've done a couple of, I'll tell you, we've done a couple of things to try to address that, and you'll work on a refined lineup, and you re-enroll the population in the appropriate target date fund. And you look 3 years later, 97% of the money is still in the target date funds, and it's probably a good place for every single one of those participants versus them trying to build something on their own. So, one of the other ways you can tackle that type of reticence from participants to really try to understand that stuff is just re-enroll them at the plan level and target date. If they don't like it, they can always leave it, right, and choose their own funds. But the vast majority stay in it, and that's, if you've got a good target date suite, that's, I think, probably a good outcome.
Yeah, it concerns me on a relative basis how little is in fixed income when you look at our participant profile. It's a lot of money in equities.
Yeah.
Yeah.
Well, there's a fair amount in the stable value fund, which is fixed.
That's more balanced. Yeah,
Well, no, the stable value is really is almost like a savings account.
Oh, really? Oh,
Yeah.
Oof, oof.
So, okay. So yeah, nothing for tonight on this, but I think going into 2021, and especially with, we'll have to monitor, what happens at Mutual of America in terms of fund offerings and everything. But, I think that we will have to kind of revisit this and look at, what that suite of options is for participants, and make sure that it's, appropriate and not overwhelming for everybody.
Right. Yeah. Keep us posted. We're happy to help as best we can.
Okay. Any other questions for Chris?
No.
No. Okay, Chris, thank you very
Thank
much.
you.
I appreciate your time and sticking with us through a couple of other presentations tonight.
No, absolutely. Let me, I'll get out of your hair here. Let me just stop share, and I will depart.
Have a nice Thanksgiving.
Have a good night. Bye.
Yeah, have a good holiday, Chris. Just as a follow-up, we didn't have on the agenda as old business. We probably should have, but I know the last meeting we talked about, John, you were going to get in touch with, I think, the town attorney about our representation from.
Yeah, I did that, and we sent out a letter to the union president of that union there, and it took about a month to hear from her because of the COVID, and she had been out and all, and she didn't see a problem in giving us a letter to release the position, but she needed to talk to her union people, and I haven't followed up on that with her, but I will.
Okay.
Everything's kind of crazy and moving at different levels, but I will check on that with her.
Okay.
Thanks, John.
Appreciate that. And the other was, I think, John, you had mentioned potentially that the finance board would have wanted us to meet with them or have a conversation. Is there anything?
We did talk about that, and then we canceled our September meeting.
Okay.
We have another meeting Monday night. It probably won't happen until after the first of the year, quite frankly, if it happens. We're getting ready to move into our budget season, and with the COVID, we may not even have our all-day budget, or may do it by Zoom. So all that's kind of up in the air on how we're going to handle all that too.
Okay.
But I'll keep you informed on that.
That's fine. Just just keep us up to date.
Yeah.
If there's anything that's there.
I think if we do have it, I think probably the best thing to do is probably have Michelle also, because they may want it. The best thing I think is probably have a presentation from her on how the two plans are going, and why you took the action you did for the last 2 or 3 years and lowering the rate, and some of the other movements you made according to her recommendations.
Okay. Okay, fair enough. And maybe some of this information that Chris had as to, where we stand relative to a lot of other municipal plans in the state. So we get, the finance board can kind of see, how we're fitting in.
Yep.
Okay. Any other items to bring forward to the board? Old business, new business? Mitch, anything for the Board of Selectmen that comes up that we need to be aware of?
Not that I'm aware of, unless there's something you know.
Not me.
We did recently pass a new police contract. There was nothing in there that affected the pension. I know we've been concerned about that in the past, the pension or the defined contribution plan.
Okay.
There'll be some retros going into both though for the catch up. The contract was a year and a half in the making. They would been working, so our auditors are working on that now.
Yeah. I mean, that the only thing there is I'm assuming that there was no adjustment in the police contract relative to a representative on this board as well.
No, that's in the contract.
That's in their contract. Yeah.
That's in their contract.
No, I mean, that's the other thing is our representation has been lacking from that side.
Whoever, the only thing I could say is whoever their representative has been, they've gotten the meeting invites through Ian and Deb before that, and I didn't hear it. I've been out of the office, so if there was a call that he wasn't coming this time, I didn't get it, but there certainly wasn't any email. I guess they're not that interested anymore.
No, remember, there's only what, three members of the police union? Two?
Three. You're right.
Three
Three.
members of the police union who are even active members of the police union who are in the pension plan right now.
But that said, I mean, we had a meeting tonight that we had a long conversation about the 401A plan, which most of the members are in, and they're missing out on that as well. So
hopefully they catch it and don't get.
Right.
or on YouTube later on.
There you go.
Maybe we should have more of the music. It might be more attractive.
Well, yes, we'll go with a live show next time. So if nothing else, no other items, I'll entertain a motion to adjourn.
Motion to adjourn.
Second.
And all in favor?
Aye.
So we have adjournment at 8:38. So thank you very much. And if we don't talk, everybody have a great holiday. And hopefully we'll get to a point where we can meet live again sometime in the near future.
Everybody stay well.
Yes.
Thank you. Same to you.
And thank you for everything.
Thanks, Ann.
Night.
Thanks.
Night.
Take care. Good night.
Bye.
Bye.
Making something else. We're going to be making gift bags now. And we hope that a lot of the products that we're using and the supplies, here again, are things that you have at home so that you can keep busy during this time of social distancing.